Did President Trump just bankrupt Harvard? 7.72% tax equivalent yield from AAA-rated Harvard University bonds. Buy now or wait. Hello, members, super savers, and bond course fans. I hope you're healthy and well. Harvard has been in the news a lot recently, and let's just say that not all publicity is good publicity. This Reuters headline from April 30th was bad enough. Trump suggests U.S. may not give more grants to Harvard University. But it got worse from there. Just yesterday, on Truth Social, President Trump shared the following message. We are going to be taking away Harvard's tax-exempt status. It's what they deserve. And as the federal funding battle rages on between Harvard and the Trump administration, it seems some of you are eyeing the attractive yields on Harvard's AAA-rated bonds, wondering whether this could potentially be a buying opportunity. From one of our members a few days back, regarding private university corporate bonds, of which there are a lot, I have been tempted to buy one of the Harvard bonds, given that Harvard has been a top institution for approaching 400 years. I see that Moody's or S&P downgraded that whole class of bonds, given the friction between institutions of higher education and the administration. Any insights? What does your crystal ball say? So 2 quick points here before we jump in. First, while our member specifically mentions private university corporate bonds, we'll be talking about both Harvard's corporate and municipal bonds today. Munis for short, because Harvard's munis have quite attractive yields. A 7.72% tax equivalent yield is what this 11-year AAA-rated Harvard muni is paying at the time of this taping, if you're an in-state resident in the highest tax brackets. The first call date is in July 2026, though, about a year from now, but more on this towards the end of the video. Whereas Harvard's highest yielding, longer dated AAA-rated corporate bonds have a 5 handle. These have maturity dates between 2036 and 2052, but more on these later as well. As a point of reference, here's where treasuries were at the time of this taping. Second, I don't have a crystal ball, as our Diamond NestEgg regulars know. That said, we did the second best thing we could in our mind and dug into Harvard's latest financial disclosures for all of you. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. How attractive are Harvard bonds currently? 2. What are the risks of investing in Harvard bonds? And in this section, we'll talk more about why taking away Harvard's tax-exempt status may be even more detrimental to the university than the freezing of all federal funding. It's what we refer to in our Lammer dinner table conversations as President Trump's nuclear option. And 3, what bonds does Harvard have outstanding? And what other factors should you consider as a potential investor? As usual, here's our front video disclaimer. For a detailed disclaimer, please refer to the end of this video. So for those of you who are new to Diamond NestEgg, I should probably add that I'm a Harvard alumna myself, having graduated from the business school in Boston proper a while ago. But keep this in mind. This content is not sponsored by any of the companies or organizations that may be mentioned in this video, nor do we receive any compensation from them if you choose to do business with any of them. As customary, we will lay out the facts about Harvard, give you our perspective as appropriate, and leave it with you to decide what is best for your individual circumstances, goals, and expectations. Let's dive in now, folks. How attractive are Harvard bonds currently? It appears that British bank Barclays sees the current noise around Harvard more as a buying opportunity than as a potential warning sign of increased risk. From Bloomberg, Harvard muni bonds are a buy, as school fights Trump, Barclays says. Now, that recommendation from Barclays came before Trump doubled down on his previous threat to revoke the tax-exempt status of Harvard. But this doesn't change the fact that in my mind, there are 3 main reasons Harvard's bonds may be a buy at the current time. 1. The spreads on Harvard-issued bonds have been widening, which is financial speak for saying that Harvard had to offer a higher yield on its most recent bond than it used to in the past. Again, from Bloomberg. Harvard sold new debt in the middle of tariff-fueled market volatility last week, with bonds maturing in 2036 pricing with a yield about 88 basis points more than the benchmark. That spread is nearly double what the school paid on a similar bond issued about a year ago. Now, those higher spreads, those higher yields on its bonds, may not be welcome to the treasurers at Harvard who have to pay them out of the university's coffer, but they do make Harvard bonds more attractive to prospective bond buyers. So that's the first reason for potentially snapping up some Harvard bonds now, yields that are higher than they have been in a long time. Reason number 2, Harvard has as good a credit risk as they come. Both Moody's and Standard & Poor's give Harvard their top AAA credit ratings all across the board. And just as a reminder, that's better than the U.S. government itself, which only has a AA+ rating from S&P and a negative outlook on its AAA rating from Moody's. These pristine Harvard credit ratings are supported by a strong balance sheet. And yes, this sometimes surprises folks who think that our country's elite universities sit innocently in their ivory towers in pursuit of pure knowledge. Harvard, like any self-respecting corporation, be it for profit or not for profit, Harvard does have a balance sheet and publishes a financial report every year. And a look at Harvard's balance sheet shows that it had $7.1 billion of bonds and notes outstanding at the end of its 2023-2024 financial year, which in our view should be quite manageable when compared to its total assets of almost $77 billion. And reason number 3 for why Harvard's bonds may be a buy. Harvard has already weathered many storms since its foundation in 1636 and built an enormous amount of name recognition, goodwill, and brand value as the oldest institution of higher learning in the U.S. I don't think I need to say much here, other than that people all over the globe will have heard of Harvard. Some may love them, some may hate them, and some may just be indifferent. But few people will ask, Harvard, who? So that's the case for having a look at Harvard bonds currently. Yields that are higher than they've been in a while, top-notch credit ratings, and massive name recognition and brand value. But, as many of you hear me say often, one of the fundamental pillars of investing is higher risk, higher return. And with the recent spike in Harvard's bond yields, this brings us nicely to the next section of today's video. What are the risks of investing in Harvard bonds? The biggest risk of investing in Harvard bonds that comes to my mind at this point in time is the university's current conflict with the Trump administration. Harvard themselves issued a warning about the potential financial impact in a supplement to the offering memorandum for its latest bond. Actions at the federal level may have the direct or indirect effect of reducing or eliminating federal support for the university, reducing the university's fundraising or other revenue sources, adversely affecting or eliminating Section 501c3 recognition or other tax benefits accorded to the university, or otherwise increasing taxes or other costs borne by the university. The legal battle with the Trump administration has two main potential implications for Harvard. First, the federal government may take away the research funding that Harvard currently gets. In the last financial year, this was a total of about $686 million, of which $496 million went directly into research, with another $190 million of federal money used on top to pay for indirect costs, including for administration and other overhead. Losing $686 million of federal funding in one go might be a big deal even for Harvard. After all, it does represent nearly 11% of the entire $6.5 billion of operating revenue for the university in the last financial year. Now, where this all stands at the time of this taping seems to be that the federal government has frozen all outstanding grants, and the university is suing the Trump administration to get the frozen amounts unblocked. The first hearing is set for July, so that may take a while to resolve. But the second potential implication is what might hurt Harvard even more. Again, what we refer to at the Lammer dinner table as the nuclear option. The federal government may revoke the university's tax-exempt status as an educational institution under Section 501c3 of the U.S. Internal Revenue Code. as Trump has threatened before and did again just yesterday morning. The danger here is less the university might have to start paying income taxes on any net operating profit. That's not such a big number currently anyway, but that revoking Harvard's tax-exempt status would affect the entire way the university finances itself. First, donations to Harvard are currently tax-deductible for the donor. This means that if alumni and friends of Harvard give some money to the university, this amount comes out of their pre-tax income, the same way employees can fund their HSA, their health savings accounts, pre-tax. If these donations were suddenly no longer tax-deductible, they would have to come out of the donor's after-tax money. The result, I suspect, would be that donations would go down substantially or might even dry up. It's just much harder to solicit donations if they're not tax-deductible for the donors. In any case, donations are a primary contributor to Harvard's massive endowment of about $53 billion. The endowment is essentially Harvard's accumulated savings and investments, which brings us to our second point. The income that Harvard generates from its endowment, the interest, dividends, and capital gains, is currently also generally exempt from income tax. Again, think of this like you would of an HSA. You put the money in before tax, it keeps growing tax-free, and you can withdraw the funds tax-free if used for an approved purpose. Health for the HSA, education for Harvard. So yes, when Harvard alumni and friends donate to Harvard's endowment, that income to the endowment is tax-deductible for the donors and tax-free for Harvard. And that money also keeps growing tax-free as part of Harvard's endowment and can also be withdrawn tax-free from the endowment so long as it's used for educational purposes. If the tax exemption were to be revoked, that nice extra tax-free kick on any investment return, so to speak, would go away, and Harvard's endowment may just see permanently lower net returns after taxes. And the third point, and maybe most relevant in the context of this video, Harvard's ability to issue tax-exempt municipal bonds also depends on its overall tax-exempt status. And not being able to issue tax-exempt muni bonds anymore would increase the interest Harvard would have to pay on its debt. We'll talk more about this shortly as well. So as I mentioned already, Trump just doubled down on his previous threat yesterday morning, but revoking the tax-exempt status of an educational institution like Harvard may not be that easy. The government will need to show that Harvard is violating its status as a not-for-profit charity, for example, by engaging directly in partisan political activities or by earning too much unrelated revenue from for-profit side businesses. Plus, the tax code essentially prevents the president or other senior members of his administration from directly or indirectly interfering with audits for individual taxpayers. That said, difficult doesn't mean impossible, and there is a precedent where the tax-exempt status of a university as an educational charity was successfully revoked over a fundamental issue of policy. Bob Jones University in South Carolina used to have a policy prohibiting interracial dating and marriage. The IRS saw this as racial discrimination and revoked Bob Jones' tax-exempt status in 1976. Bob Jones defended itself by claiming to follow sincerely held religious beliefs under the First Amendment. The case went to the Supreme Court, which ultimately sided with the government and established the precedent that an institution seeking tax-exempt status must not be contrary to established public policy. And along the way, the Supreme Court also defined tax exemption as a privilege, not a right. And by the way, the Supreme Court issued its ruling in 1983, 7 years after the IRS first took away Bob Jones's tax exemption. If the current battle between Harvard and the government drags on for a similarly long time in the courts, we may have to wait for quite a while before we can know for sure how this will end. But it seems the question that's top of mind for many people is this: is federal funding, our hard-earned tax dollars, really so important for the wealthiest private university in this country? Well, let's take a look again at what Harvard's numbers tell us. For the academic year 2025 to 2026, the total tuition for Harvard is $86,926 per student, according to their website. And by the way, that's compared to the median annual gross earnings of about $62,000 for full-time wage and salary workers in this country, according to this recent BLS report. Plus, Harvard has a massive endowment of about $53 billion, as we just discussed. So, with such high tuition fees and an endowment of around $53 billion, does Harvard's future really depend on whether the federal government will continue to support it? And the answer to this question, as so often in life, is it depends. On the one hand, Harvard might rightfully be considered a wealthy institution that would probably have a bit of a buffer if support from the federal government dried up. But the university also has an underlying vulnerability that might make it a bit more exposed, financially speaking, than one would think at first glance. Basically, ever since COVID, Harvard has increasingly struggled to make ends meet. In the financial years from 2022 to 2024, Harvard's expenses grew faster than its revenues. While total expenses increased by more than 18%, revenue growth could not keep pace at a rate of a bit less than 11%. What this means is that Harvard's net operating surplus diminished substantially. It seems Harvard has a spending problem that's not dissimilar to that of our federal government. In the financial year 2024 alone, Harvard's net operating surplus shrank to a mere $45 million from $185 million in 2023. That's a dramatic reduction of more than 75%. And if we go back just one more year, the university had even shown an impressive net operating surplus of $406 million in 2022. Now, we'll need to see how these numbers will look for the ongoing financial year that ends on June 30th, but based on current trends, it does seem that Harvard might potentially be more vulnerable to financial pressure than their always finely manicured lawns would lead us to believe. This potential exposure also comes from the fact that the endowment, impressive as it was with more than $53 billion in investments at the end of the last financial year, might offer less protection than many would have expected, as the university says itself in its last annual report. There is a common misperception that endowments, including Harvard's, can be easily accessed like checking accounts, available for any purpose at any time as long as funds exist. In reality, Harvard's flexibility in spending from the endowment is limited by donor conditions and the principle that endowment funds are designed to last forever, crucial for serving future generations of students and advancing new knowledge. Plus, the endowment was already paying for more than a third of Harvard's budget last year, 37% to be precise. And it's not clear from the outside how much additional money Harvard could take out of its endowment at short notice without starting to run it down and potentially violating both donor restrictions and the last forever mandate. Right. Now that we've gone through both sides of the story, why Harvard bonds are attractive at the moment, as well as the potential risks of investing in them, let's move on to the next section of today's video. What bonds does Harvard have outstanding? And what other factors should you consider as a potential investor? As I mentioned at the beginning of this video, Harvard issues both taxable corporate bonds and tax-exempt municipal bonds to help raise the cash for its ongoing operations. And E-Trade seems to be the most user-friendly in this case. Here is the list of top-yielding corporate bonds from Harvard on E-Trade's platform at the time of this taping. The CUSIP for this one, with a maturity date in November 2052, a first call date in May 2052, and a yield to worst of 5.524%, is 740816AQ6. And on the other end of the maturity spectrum, the CUSIP for this one, with a maturity date in March 2036, a first call date in December 2035, and a yield to worst of 5.016%, is 740816AT0. For tax-exempt municipal bonds, here are the 4 top-yielding ones that were available on E-Trade at the time of this taping. Remember that these municipal bonds may be partially or totally tax exempt for an individual investor, depending on your personal situation. Check out these corporate and municipal bond videos here, linked below in the first pinned comment, if you need a quick overview on either type of bonds. Bond beginners, folks, I would highly recommend going back to Module 9 on municipal bonds and Module 10 on corporate bonds if you need a refresher on safety, taxation, the de minimis rule, and so on, to see whether corporates and or munis may be a good fit overall for you. So, before we dive deeper into the yields on the Harvard munis, please do keep in mind that the nominal yields on tax-exempt munis are usually significantly lower than on an equivalent taxable bond, not surprisingly. To make these potentially tax-free yields comparable to the yields from a taxable alternative, such as T-bills, agencies, and corporates, I generally recommend taking a first cut via one of the after-tax yield conversion tools that are available online. For example, Fidelity's taxable equivalent yields calculator will give you your personal after-tax equivalent yield for any municipal bond that you may be interested in, based on where you live, which tax brackets you're in, and whether you're single or married. I've linked this tutorial on how to use Fidelity's tax equivalent yield calculator below in the first pinned comment. So back to the Harvard munis that are available on the secondary market via E-Trade's platform. The highest yield is this 4.172% for a bond that matures in July 2036, with a first call date in July 2026. This is equivalent to a yield of 7.72% for a taxable corporate bond held by a Massachusetts resident in the highest tax brackets who is married and filing jointly. The number that I showed you at the beginning of this video. The QSIP is 57584XY C9 for this one. If you're looking for non-callable munis, this is the top yielding one here with a maturity date in November 2035 and a yield of 3.5%. This is equivalent to a yield of 6.48% for a taxable corporate bond held by a Massachusetts resident in the highest tax brackets who is married and filing jointly. The QSIP is 57585BGU6 for this one. If you're with Fidelity, Schwab, Vanguard, or another leading broker, you can use the QSIPs that we just shared with you to search for the bonds that interest you most on those respective platforms. Not every broker will have the same availability, minimum and maximum purchase quantities, and so on. So the rates that I just shared with you can be quite attractive for someone interested in AAA-rated bonds. That said, there are at least 3 important factors to consider as a potential Harvard bond investor. First, for Harvard's muni bonds, you need to be in a fairly high marginal tax bracket and a resident in Massachusetts or in another state with no or fairly low state and local income taxes to really benefit from the tax-exempt status of Harvard's muni bonds. This is one of the primary reasons why Harvard's muni bonds would not be a good fit for us personally. We would have to pay fairly high state and local taxes on all of these Harvard muni bonds, which kind of defeats the purpose of owning tax-exempt munis. New York, in fact, is one of the few states with an even higher top state income tax rate than Massachusetts. So when we do look at munis, we generally only look at in-state ones to maximize our personal tax efficiency. But as I said, if you live in a state with no or fairly low state and local income tax rates, then this may not be an issue for you. Moving on now to the second important factor to consider as a potential Harvard bond investor. Corporate and municipal bonds are often issued in smaller volumes, making them less liquid, especially when compared to treasuries, which remain the safest, most liquid investment globally. So, for example, the latest taxable corporate issue from Harvard was $750 million, and the latest tax-exempt muni issue from Harvard was only for about $434 million. As a point of reference, the next 3, 10, and 30-year Treasury auctions are expected to be $58, $42, and $25 billion in size, meaning that if you ever have to sell your Harvard bonds before maturity, you may have to wait longer for a buyer or accept a lower price than what you had originally anticipated. I've linked Harvard University's Office of Treasury Management website in the first pinned comment below for you. If you scroll down this page, you will find more information on their bond issuances because the details can get fairly complex. As always, make sure you read the fine print and understand what you're buying. And of course, do consult with your tax advisor if you have more specific questions pertaining to your personal situation. Moving on now to the third important factor to consider as a potential Harvard bond investor. You need to decide whether you're personally comfortable not just with the higher education sector overall, but also with the university's positioning and the unpredictability that this may bring with the government in the coming weeks, months, and possibly even years. For instance, I know that some in our Diamond NestEgg community will not invest in certain industries and or companies because they don't believe in them as a matter of principle. Tobacco, gambling, and oil and gas are what comes up most often. And I know others in our Diamond NestEgg community who don't care which industries or companies they invest in. All that matters for them is the return and how safe the company is. Meaning, in this case, it may or may not be a matter of principle for you as well, whether you invest or not. Is the return on Harvard's bonds all that you care about? Or does it matter to you whether your invested dollars may support protests on their perfectly landscaped lawns? Is Harvard's stance on DEI and other topics relevant to you? And do you want to give it some support or not? And even if you're a step removed from the underlying issues, are you comfortable that there may be an uncertain outcome from Harvard's ongoing legal battles with the Trump administration and that this might potentially impact their AAA rating or even their tax-exempt status? For example, if the ongoing press coverage and the uncertainty about these topics will keep you up at night because you own bonds in Harvard, then you should ask yourself, is the higher return worth those sleepless nights? To be clear, I'm not afraid that Harvard may default on any of its outstanding bonds in the foreseeable future. The university has just too much substance for that at the time of this taping. But as you can see from everything we've talked about today, the case for buying these nice yielding Harvard AAA bonds may not always be completely straightforward. So, how are you thinking about all this? After we've laid out the facts and financials on Harvard, do you see the recent widening of spreads on Harvard's bonds as an opportunity? And will you be picking some up for your personal portfolio? Or do you see the higher yields on Harvard's bonds as a signal that the risks might be growing? And do you think that the university will regain its footing? Or do you think their credit rating will suffer? Or in the worst case scenario, could they even lose their tax-exempt status? Losing their tax-exempt status might be really bad. Anyway, drop a comment below and let me and the community know what your thoughts are. And for those of you who subscribe to Your Financial Journey, check out Caitlin's and Ava's brand new video here for a deeper dive into why Harvard and other private universities even receive any federal funding from our hard-earned tax dollars at all. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building a bond portfolio while rates are at good levels, then check out this video here on our bond courses. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.